Rock monthly video for March. Today, we shall address how financial markets performed last month and what the implications for your portfolios are in the near term. Some key adjustments to our models, if we have them, special mandates, and how our managing risk first philosophy will be the key to maintaining growth in these uncertain times. I'm Scott Tomlinson. With me on the call today is Paul Tepsich, who founded High Rock in 2010. We started our private client wealth management division in 2015, and we are almost at our 10-year anniversary next month. If you're interested in learning more about us, visit our website at www.highrockcapital.ca. All right, well, let's talk about February. It wasn't really a significant month for the most part. Most asset classes were pretty close to flat, and balanced portfolios, we'll talk about those just a bit more, but they were pretty much right at flat. The only thing that we've started to see is a little bit of a move out of US equity assets into international equity assets. And that rotation is probably overdue, as international assets have remained fairly cheap since the downturn of 2022 relative to US assets, and all of the uncertainties that are being caused in the US these days are starting to impact that even to a greater degree. Paul, if you have anything you want to throw in here, I'll turn it over to you.
Yeah, I think given what's going on in the world now geopolitically, we're seeing a resurgence in non-US equities, Europe, Middle East, Asia, Africa, simply because now everyone's figured out, hey, we got to take care of ourselves here. And they're putting forth a lot of stimulus into their economies, and their businesses are benefiting from that. And I think that's part of the reason why we've seen that in these international non-US economies.
Yep. As I mentioned, balanced portfolios were pretty flat. We look at the Morningstar averages just to get a gauge as to how they compare to our client portfolios. If you wish to engage in regard to your specific portfolio, we want you to reach out to us. We are happy to have those conversations. And we shall be here for you. And if you want to discuss how your portfolio is built around dealing with the risk and the uncertainties that we're dealing with right now, we are certainly available to have those conversations. Paul, anything you want to add on the mandates? No, February is quite a month, so.
Yeah. For both our high yield special mandate and our preferred share mandate. Both were up small on the month from a performance perspective. And we're not super volatile. Moving into the past week, now we're at March 6th as we record this. Probably most people are aware of what's going on here with Trump and tariffs, certainly in Mexico, Canada, but around the world. The volatility has picked up enormously. Both of these mandates so far, Scott, are holding in quite well. And maybe I'll just mention, certainly in the high yield space, they are structurally senior, which sounds like a complicated term, but they're more safe and secure than their underlying stocks or equities. So they're much less volatile, and you're getting paid a coupon every day you own these bonds. So these bonds, especially, we've got about 35% of our portfolio in the high yield mandate in energy bonds, and they have very, very strong balance sheets. So although their underlying stocks have been uber volatile, the bonds really haven't moved much at all. So I'm quite pleased with that. And preferred shares seem to be holding in quite well the past week. but they're a little trickier because they are like a hybrid equity. So not totally sure how they're going to behave at this stage. That mandate, Scott, is has a very large cash weighting, so I'm comfortable with that and the risks that we're taking right now. That's it.
That's good because as we can discuss, cash at this particular moment in time is a very good defensive asset in especially in times of this kind of volatility.
I think it's probably the only asset off the top of my head that hasn't gone down this week.
Yeah, well, there you go. As always, we are focused on your long-term goals. If your long-term goals are changing or you want to revisit them, please, again, reach out. We are standing by to have those conversations, and if necessary, revisit your wealth forecasts and your portfolio strategy. Okay, let's quickly jump to the global equity strategy. We do monitor the fear and greed index, which has dipped below 20 in the last week. And as a result, we've been spending a little bit of cash that we had or a little bit of the cash that we had rebalanced out of equities into cash late last year. Anybody who has a little bit of cash, we are putting some of that to work, or have been putting some of that to work at the current levels, and we'll look if there are further deteriorations in stocks. We will look to nibble away at positions that we think are represent good value.
Scott, I would just add there too that we're not smart enough to pick tops and bottoms and put 100% of our money at the bottom. So when Scott says we've been picking away, and those that are a bit more overweight cash than others, we're doing what's called dollar cost averaging. So when the market has a really big down day like today, we might add, 1% or 2 or 3 in line with our view in the overall market and where it might go. I think probably, Scott, you would agree that with the new administration in the White House, anything can happen, and it happens typically multiple times a day. So we really don't know where things are going to go and what's going to happen. But what we can do is try and pick our spots and just redeploy a little bit of capital here and a little bit there. And conversely, if it trades up higher, we may sell a little bit, but it won't be en masse. We're not going to spend a client's entire capital or cash position in one fellow swoop.
Well, and again, back to the defensive nature of cash. Sometimes it's not bad to keep a little on hand for further deterioration in the markets, or what we'll call development of better value.
100%.
All right, I'll leave that to you to discuss the tactical.
Yeah, so across the month, there was, in the tactical model, there was really only one trade, which did not work out well. I ended up buying a Alabama-based thermal coal, metallurgical coal miner, and very close to Tidewater, largely export driven. This company was trading very, very cheaply on a few different metrics that I follow. Unfortunately, shortly after we bought it, it pretty much imploded down. So I took our small loss, and kind of that's it for that one. Just did not work. So the rest of the month was actually reasonably flat for most of our other positions in there, most certainly our bond positions, but even our stock positions were pretty flat, low volatility. But we probably will talk, I will talk a little bit about the past week. For sure, 2 of our notable positions in the tactical model being Baytex Energy and Source Energy. Source Energy is a fracking sand miner. They have mine in Wisconsin. And they train the sand up to the Western Canadian Sedimentary Basin. This is a company I've talked about before. We used to own the bond. They have almost 50% market share in the basin in Alberta and BC. And yeah, that stock has been hit really, really hard the past week or so. It was trading cheaply, and it's like anything else during times like these, it's getting even cheaper. We will maintain that position. In fact, I just had a call with the CFO yesterday. They are putting an application forth to Ottawa to get their fracking sand exempt from any tariffs. Otherwise, I think think about this, as he said to me, they're going to pay a 25, if the tariff goes through with a 25% premium coming into Canada, if the Canadian government charges 25% tariff on a Canadian company's sand from the US. So these oil and gas producers are going to pay a 25% premium. Then they're going to have to eat a 10% premium on the oil and gas going into the US market. And the US refineries need Canadian heavy oil, make no mistake, because that's what their refineries accept is Canadian heavy oil. That's going to shut down the entire basin. And quite frankly, some of these energy stocks are trading that way at this stage. And the other one we have is Baytex Energy, which is an oil producer, and 60% of its revenues come out of Texas. So only 40% are in Canada. This stock now is this Baytex Energy is, given the past week, is now trading at or coming on a 4-year low. And yet, as I said to a friend of mine yesterday, I won't run through all the metrics, but its credit metrics, its valuation metrics are all way stronger than they were 4 odd years ago when oil was at $65 or $70 a barrel. They have less debt, they have more cash flow, they have a lower equity value or lower valuation on their entire enterprise than they did back then. So you could buy this company with 20 odd years of oil in the ground for basically 2 years worth of their cash flow, and you'd have 23 years of oil ahead of you. So that's how cheap some of these companies are getting now. And that one in particular, it's somewhat insulated with 40% of its revenues in the US. Anyway, that's what happened over the past month of February, which was not much, and also what's happened over the past week. I guess I will mention another one, which doesn't really affect us because we have such a tiny, tiny position in it. But Sherritt issued a couple days ago a restructuring of their debt. It's such a small position for our balanced holders. It's pretty much irrelevant. Our high yield clients do own it, own the bonds, that is. So I'll leave that for them. So that's it for the tactical, Scott. I know I kind of went on there.
That's okay. It's always interesting for some to hear what your strategy is and why we own certain situations. So I think it was all pertinent. I'll let you talk about fixed income now.
Okay. I'll keep this broad. I mean, obviously February was static again, very low volatility. And then we'll move into the past week. And quite frankly, within that pie chart we're all looking at, preferred shares and high yield bonds probably, and investment grade a bit, have held in okay. Government bonds are starting to get hurt. And I'm happy to hear your views, Scott, but one thing that I fear may happen, and again, I don't think any of us have really any firm views as to what Trump may or may not do with regards to tariffs. But if they do become more permanent, The one thing I'm quite worried about is our government bond yields, which affect investment grade bond yields and which will affect everything, is that the federal government and the provincial governments will run massive deficits. I think they would run COVID style deficits, which, if you recall, over a 2 year period, the peak of COVID, the federal government put in about $500 billion of stimulus into the system, which we now know has led to the inflation situation that we are in today. But if these tariffs do end up being permanent, or even for across a 6 month period, I could see those deficits being enormous, and that puts a lot of pressure because on government bond yields, because the government has to come in through the Bank of Canada and issue a lot more bonds. So it's simply a supply-demand dynamic. On the other side of that, the very short term, i.e. overnight, maybe out to 2 year bonds, would be a very protective place to be, because the Bank of Canada, I think, will be forced to cut rates dramatically. I would think at least, every meeting they cut 25, maybe even intra-meeting, and maybe they go 50 or more. They could really do that. But all this leads to potentially to stagflation, which is low economic growth with high inflation. If we see that, the longer part of the government yield curve, 10, 30-year bonds are going to get hurt. Investment grade bonds get hurt. High yield bonds get hurt. Preferred shares actually might do pretty well. That's where we are, and those are my concerns.
All right. Well, understood. Lots of uncertainty between now and until we find out exactly what the end game is.
Yeah, that's not very uplifting. I'm sorry, but that's how I see it.
Well, knowing that this is the potential, our clients should be rest assured that we're doing everything in our power to protect them and protect their capital. All right. Let's talk a little bit about tax season. I went through this last month, so I won't belabor on it, but you can access your Raymond James account through our High Rock website. In there, you can look into your tax documents. And again, if you need any help with any of this, you're more than welcome to get in touch, and we're more than happy to assist. Access to your Raymond James website. If you need us to provide the tax documents, just let us know. There is a schedule. We've highlighted the schedule last month, but again, one of the things that we want to make sure you don't file your income tax until you've received all of your T3s, and if you need return of or if you need gains loss reports, the return of capital adjustments are not done until late March. So Raymond James is recommending that you don't file until after March 27th, when we can provide more accurate return of realized gain loss reports. And that hopefully is it. Again, if you need any assistance with any of that, please get in touch with us, and we're standing by to assist in any way that you need. But in the end, as always, we want to thank you for taking the time out of your busy schedules to tune in. We will be back at the beginning of April. So until then, this is Scott Tomlinson, and on behalf of my colleagues, Paul and Diane, we want to wish you the best until then.